Hey guys, how's it going? I want to talk to you today about something that's been on my mind lately, those Yieldmax ETFs and how I've been thinking about them completely wrong. If you've been following the channel, you know I've been holding a bunch of these high yield ETFs and I want to share some realizations I've had. So these Yieldmax ETFs and other covered call funds have been showing me something during this recent market pullback that's got me rethinking my whole strategy. And when I first got into these, I was mesmerized by those crazy 30 to 40% yields, thinking, man, this is the ticket to retirement income. But reality has been teaching me something else. Here's what I've noticed, and maybe you've seen this too. When the market goes up, these funds get capped because of the covered call strategy. Let's take something like CONY as an example. The price will go up a bit, but then it hits that ceiling and you don't get the full upsides. That's just how covered calls work, right? But here's the real issue. Like when the market pulls back, guess what happens? The share price drops and the dividend yield drops too. It creates this nasty double whammy where you're getting hit from both sides. You don't fully participate in the upside, but man, you definitely feel that downside. And that's what's had me thinking, is this really the best strategy for long-term retirement planning? I did some math on this recently, and it's actually pretty eye-opening. For me to maintain a steady income stream from these high yield ETFs during a significant market downturn, I'd need like 4 to 6 times more capital than I originally thought. That's crazy. We've only been in about a 10% correction so far, and I'm already seeing some significant dividend drops in some of these funds. Now, think about what happens in a real bear market, like a 30 to 40% drop that lasts for a year or longer. How low would those dividends go? How much more would I have to keep buying just to maintain the same income level? It's kind of terrifying when you think about it. Now, compare that to something like SCHD or VTI or even QQQ. Yeah, they have lower yields, around 3 to 4% for SCHD, but their price appreciation over time more than makes up for it. And most importantly, their dividends are way more stable. They might even grow during tough times, not shrink. Think about it this way. If you're planning to actually live off these dividends in retirement, do you want to be dealing with an income that's $3,000 1 month and then suddenly drops to $2,200 the next because the market pulled back? That's tough to budget around, right? I mean, you got bills to pay that don't care about market conditions. I looked into some actual data on this. During bear markets, covered call ETFs like QYLD can see their distributions drop significantly. According to what I found online, when expected market volatility declines, so do option premiums, which directly affects how much these funds can pay out in dividends, with potential swings of 30% and 50% in dividend income in any given year. That's a huge problem if you're counting on that money for living expenses. Don't get me wrong, I'm not saying these yield max strategies are bad. They still have a place in a portfolio. In fact, that's my big realization. I should be using them for their strength, not their weakness. What's their real strength? Like return on investment, ROI. These funds can actually reach ROI in a much shorter time frame than traditional investments. With something like NUSI or CONY, you can potentially get back your initial investment in just 1 to 2 years through those high check distributions. After that point, everything else is essentially profit. And so here's my new approach. I'm shifting more of my core holdings into funds like SCHD, VTI, and QQQ. These might pay lower yields, but they're more stable and have better long-term growth prospects. Then I'm keeping a smaller allocation to the high yield stuff, but I'm treating them more like tactical positions to generate ROI quickly, not as my core retirement income source. I'm going to use these high yield funds almost like a leap option strategy. When the market finds a bottom, I'll put some money into funds like CONY, NUSI, or one of the other Yieldmax ETFs, collect that outsized yield until I hit my ROI break even, and then either reinvest those distributions into my core holdings or use a small portion for current income needs. The way I think about it now is that something like SCHD giving me 3 to 4% that slowly grows over time is actually way more valuable for retirement planning than a Yieldmax ETF giving me 30% that could drop to 15% or less during a market correction. Another advantage of the more traditional ETFs is that according to studies commissioned by the CBOE, a covered call approach is usually considerably less volatile than the market itself. But here's the catch. This lower volatility comes at the expense of giving up some upside potential. Also, some of the more advanced ETFs like NUSI actually try to address the downside protection issue by buying put options alongside their covered call strategy to mitigate risk during market corrections. That's something to consider if you're worried about downside protection. The bottom line is that I'm realizing the amount of money it would take to build a reliable income stream solely from Yieldmax ETFs is much higher than I originally thought. For the same level of reliable income, I'd be better off with a larger allocation to dividend growth ETFs like SCHD supplemented with a smaller portion in these high yield strategies. So yeah, that's what's been on my mind lately. I'd love to hear what you guys think in the comments. Are you sticking with the high yield approach or are you more focused on total return and stability? Let me know. Before I wrap up, I just want to say thanks for watching my ramblings. And if you're not subscribed already, hit that subscribe button. I try to share these portfolio updates and thought processes as I learn and evolve so we can all grow together. Thanks for watching, and I'll see you in the next video.